Welcome back, guys. My name is Adam Adams. I am the host of the Creative Real Estate Podcast. And today, our episode, this is going to be short. It's just a listener's question who is asking, should I be on the sidelines? So we're talking about the market today, right? And everybody knows that the market is pretty hot right now. So I've got these questions coming in like we should probably just be sitting on the sidelines. There's no reason to be putting money into big multifamily if the interest rates are what they are, if the cap rates have been compressed so much. And we've talked about cap rate before, but let's define something real quick because it's important. If a cap rate is 10% and the whole income for that property, the net income anyway, is 100 grand and the cap rate's 10%, that means it's worth $1 million. If the cap rate is 5%, that means the property is going to be sold at $2 million. And if the cap rate is 2.5%, that means the cap rate is going to be $4 million, or the price is going to be $4 million on a 2.5 cap for that same 100 grand. So as the cap rates continue to compress, to get smaller and smaller and smaller, that means that the price that you have to pay for a property that's making a certain amount of income is going to be getting bigger and bigger and bigger. So if you had a 20 cap, what does that mean for 100K? A 20 cap would be, I think, like 5 times the value, which would mean 500,000 is a 20 cap. And so anyway, this is a great metric to kind of see. And people are saying, hey, if the cap rates are so compressed, if the prices are so inflated, should I just be sitting on the sideline? I've got a few reasons why the answer is no, you should definitely not be sitting on the sidelines. And here's a few of them now. Number one, if you're not completely analyzing deals all day, every day, what's going to happen is you're not going to be able to see when the market changes. You're going to be so far removed from it that it's going to pass you up. And the number two is that if and when it happens, when there's a market correction and the prices change, you're going to be put yourself into a bad position because you're not staying sharp. You're not understanding the market, and you won't be able to move. Number three is if you go out and sit on the sidelines, you're going to be cold. That means to me that your brokers, the people that are going to be bringing you deals, are not going to be the ones bringing you deals when you were just sitting on the sideline for a while. The fourth reason is that there's still money to be made, guys. The reason being is that multifamily is one of the safest asset classes in the world. Multifamily, just as an example, is let's look back in the time where all of those foreclosures were happening, where people were giving up their homes back to the banks because they had to, because they couldn't afford it. Well, even still at that time, at the worst time in the last 10 years, back in 2008, I guess it's exactly 10 years ago, is that multifamily still had a 0.8% default rate. That's less than 1% default rate. And so it was still a very, very safe asset class. And part of that is because of how the banks underwrite the deal. We talked before about a DSCR, debt service coverage ratio. This is a ratio in which the banks underwrite to make sure that they're going to get paid back regardless of what happens with your property. They're still going to get paid back. Banks are not in the business of losing money. They have a 1.2 and 1.25 are their minimums. You have to be able to make at least basically 20% more than the mortgage costs you in net operating income every single year. And if by doing that, that they know that they're going to be getting paid back. So if you just look at all of the asset classes, multifamily is one of the absolute safest. And then we have the reason number 5 is because you can mitigate your risk anyway. So even though we're talking about the multifamily being one of the safest places, and you can still make that cash flow, and they have, in the worst of times, less than a 1% default rate, there's still a way for you to mitigate your risk even further by doing what my company does, and that's by having much, much, much higher than the minimum that the banks make us have for DSCR. Our company focuses at a minimum of 1.6% debt service coverage ratio, which means we make 60% more in our pockets than the mortgage costs us in the first place. If it's $160,000 for your net operating income, that means 100 of it goes to the bank, and 60 more thousand comes straight into our pocket, and we can easily pay the mortgage. We find deals, guys. Our last one was 2.1% DSCR. What that means is we had more than 100%. We actually had 110% more than the mortgage cost us. So if that is 100K for the mortgage, that means we kept 110K. So there's ways for you to mitigate your risk anyway. So now is the time to get into multifamily. It doesn't matter what's going on with the economy. And actually, I have a bonus reason for you guys. It's reason number 6, and that is that there is market cycles. So you need to be able to pay attention to different markets. So there might be markets out there that are at the top, but at the same time, at the same exact time, there are other markets that are just starting to come out of their shell, and the cap rates are getting better and better. So just because you're in a market yourself where you're not able to find something that makes sense for you, there's probably 10 other markets around the country at any given time that are perfect for you to be investing in. I hope this helps, guys. I'll talk to you guys later. Bye.